Okay, good morning everyone. May I have your attention please? Our subject today is measurement of performance for strategic investment units, where the strategic investment units can be the companies as a whole, and then within companies, strategic business units can be investment centers where the authority is delegated to make decisions over the procurement, operation, deployment, and operation of productive assets. So we are dealing with measurements of those units. And one of the oldest measurements, the origin of which goes back to the earlier parts of the 20th century, is the return on investment. And actually the return on investment, like most concepts in management accounting, is conceptually a fairly simple and straightforward concept. So basically what we are saying in return on investment, that it's a ratio measurement, where in the numerator we have profits and in the denominator we have assets, and the assets are supposed to be all the productive assets that are participating in and engaged in generating the profits for the investment units. And we simply divide the profits by the assets to get a measurement of what do the assets return to the unit in terms of profits. So that's all there is to it conceptually. So for example, if you measure the ROI and you get 0.16 or 16%, what that is supposed to mean is that by this measurement for a certain period of time, say a quarter or a year, depending on what period of time you measure it for, your assets returned in terms of profits 16%. So 16% of the value of the assets you invested has been returned to you as the investment center in profits. So obviously, the higher the better. You wish a higher return, you wish more of a return. The higher the return in terms of profits or investments, the better the performance is. And you can compare this performance for a unit over time, how much it increases or decreases over time, and you can compare this performance to comparable units, companies to other comparable companies, or investment centers within the organization comparable to other investment centers. So conceptually, it's quite simple. As typical of management accounting, most of the issues reside in the details of the measurement. So remember, accounting is to a large part a discipline that is concerned with measurements. So many of the issues are issue of measurements. What do we measure? How do we measure? And how we interpret the measures. So return on investment is no exception. In addition to return of investments, other measures, frequent measures of performance of investment units are the return on equity for the company. So return on equity. What is the return on the value of the equity? And of course, for company or centers, the net present value, which is a measure you know well from your finance course, which is the present value of the net cash flows. Let's focus on return on investment. Return on investment, which as we said is profits over assets, can be also presented as a multiple of two measures, two ratios. First ratio is profit over sales, dollar sales, which is the return on sales. How much profits do you return on sales? And if you multiply profit by over sales by another ratio, which is sales over assets, which is called the asset turnover. What is the capacity of the assets to produce sales? If you multiply the two ratios, you can see that sales in the denominator and in the numerator will cancel off, and you will get profits over assets, which is the return on investment. So you can present the return on investment as a multiplication of the return on sales times the sales turnover. And we are sure to go today over a detailed numerical example so that we make those concepts concrete. Now, before we do that, let's consider in general some of the issues. First of all, of course, if you want to use a measure like return on investment to compare what happens over time or cross-sectionally, this requires a consistency in the measurements. So it should be measured consistently, because if it's not measured consistently, if there are differences in period related to the accounting methods used, if there's a change in the accounting methods when you compare units or you compare periods, then you don't know how much of the change is due to the accounting method change and how much change could be inferred as a change in performance. So these things get scrambled, and then it's very difficult to analyze. So that's obvious. So let's go to the measurement issues, and let's dichotomize them to measurement issues that reside with the numerator of the ROI, the profits, and what resides with the denominator, the asset base. So let's start with the profits. Well, with the profits, you know, we'll go just over some of the more important issues very quickly, because you, as accountants, you know what are the major issues in measuring profits. If, for example, we want to measure profits as earnings, then we are familiar with the many different methods that we have to decide on. For example, we have to decide on how we recognize what are our recognition rules and policies for recognizing revenues and recognizing expenses. What do we recognize as a revenue and expense, and when do we recognize it? At what period do we recognize it? That is one important method which is going to affect, and any choice in method is going to affect the earnings. Depreciation methods are, for example, very important. Do we use economic depreciation or do we use accounting depreciation? And if we use accounting depreciation, what kind of accounting depreciation method do we use? Do we use straight line? Do we use sum of digits? Do we use declining balance, some of the accelerated methods? And so forth. So that would be an important issue of measurement. Likewise, inventory methods. Do we use LIFO, or do we use FIFO, or do we use specific inventory methods? If we are measuring different centers within the organization, how do we allocate the costs? Non-recurring items, income tax effects, foreign exchange effects, and of course the list is by no means exhaustive, but just reminds you that there are many different ways to measure earnings or profits, which is the numerator. So let's look at the denominator effect, and in the denominator, remember what ideally we want to do for the return on investment measure to be comprehensive. We want to try to include all the assets, all the productive assets that participate in the generation of the profits or the earnings that we measure. So that's easier said than done. Well, it's easy to say we want all the comprehensive measure of all the assets, productive assets that generate the revenue, but then comes the specific issue, okay, which assets do we include? They have to become specific. Do we include intangible assets? Do we include only tangible assets? But what if intangible assets are important? If we want to be comprehensive, we have to include them. How do we include them? What kind of intangible assets do we include, and how do we measure them? No means an easy issue. Another very important issue is capitalization versus expensing. What items do we capitalize? And the portion that we capitalize will include, obviously, as part of the assets. And what items do we expense? And the portion that is expensed or is obviously not included in the asset base, but is then included in the expense component of the earnings. Now, when does this issue arise? Give you a number of examples. I'm sure you've discussed it before. Let's assume we talk about companies where research and development is very important. Where what do you do for any particular period with the totality of the research and development expenses that are incurred for that period? Do you expense all of it for the period? You could. If you do that, then it will be all expensed and everything will be included in the profit component in the numerator, where profits, of course, are revenues minus expenses. But arguably, you could say that research and development, that the benefits of research and development, if the research and development is effective at all, are extended into the future, hopefully into many periods of the future. So if you want to match revenues with expenses, then maybe what you want to do is to take the bulk or the large part of R&D expenses in any particular period and capitalize them and treat them as an asset which is going to be amortized over the future period where those research and development expenses hopefully generate additional revenues. So in that case, the bulk that your expense will go into the denominator as an asset, and only a small portion will go at the expense into the expense component in the numerator. So research and development is one example. Advertising. Again, effective advertising has benefits that go a good number of periods into the future. Any particular period, do you expense all the advertising, or do you capitalize a good part of it? That will determine whether you included that period, how much you include in the denominator in the assets part, and how much you include in the profits part in the numerator, and will affect your ROI, the return on investment. Another example are training. Good training, thorough training, important training is likely to be affected also, to be apparent also in terms of its effects in future periods, in terms of higher quality work by the employees that are trained. So that part maybe has to be capitalized and amortized in future periods. Now we know that GAAP usually requires that such expenses as R&D, advertising and training would be expensed in the period that they are incurred and not capitalized. But we're talking here about measuring performance for internal reporting, and therefore we are not bound by GAAP. So if we feel that it's better that we capitalize such expenses, we're free to do that. So it's our choice. Allocation of joint used assets, if you talk about return on investment of units, investment units within the organization. Now very importantly, let's assume we agree on what assets we include in the denominator. The next very important question is, how do we value those assets? We have to assign them a dollar value. There are many alternatives. You can assign to them book value, and it can be gross book value, gross of depreciation, or net book value, which is the acquisition costs of the assets minus the accumulated accounting depreciation. Or it can be the replacement cost of those assets, or it could be the liquidation cost of these assets. What will be the cost of the value of the assets if you liquidate them, or it could be the market value of those assets. What is the market value of those assets as a market at this point? You can use any of those valuations, and they can produce significantly, radically different numbers. And depending on which method of valuation you use, that will affect the magnitude of the dollar figure of your asset base, and obviously will affect your return on investment. Well, we said gross value or net book value, which means gross of depreciation or net of depreciation. If you take it net of depreciation, then, as we said, the way you measure depreciation is important. So the way you measure depreciation is important if you use net book value. It's an important factor in the denominator, and of course it's always an important factor in the numerator, because depreciation is an expense and it figures in the calculation of profits or earnings as revenues minus expenses. Now, the other question is, remember the ROI is a measure of profits over assets. Now, profits or earnings are a flow concept. They represent the flow of revenues minus the flow of expenses over the whole period. So if for the profits for 2013 is the flow of revenues minus expenses for 2013 over the whole year. Assets are measured at a point of time, so they're a stock concept. So the question is, when you measure assets, if you measure ROI for 2013, we know that you'll measure the profits as the flow for 2013 from beginning to end. But at which point in time in 2013 are you going to measure the assets? Are there the assets at the beginning of the year? Are there the assets at the middle of the year or at the end of the year? You have to decide. Usually what is decided in those measures is to take some kind of average, so that you present some kind of average of the assets that were deployed throughout the whole period. But you have to decide whether you take an average and which average you take, and that will affect your ROIs. Then there are time issues, because you have, first of all, to decide which periods of time you measure the ROI. Do you measure it for a year? Do you measure it for a quarter? Do you measure it for 2 years? Do you measure it for 5 years? Do you take a 4 or 5 years measurement and do a moving average? There are many possibilities that will produce different measurements that will have to be interpreted differently. Now, the other important issue is the interdependence of ROI over time, which also leads to short-term orientation versus long-term orientation. I'll give you an example that happens frequently. Let's assume you measure the ROI for 2013, but the decisions, the capital decisions and investment decisions that you make in 2013 can very well affect future periods. They will affect 2013 in ROI measurements, but they can affect future ROIs as well. For example, let's assume that you decide in 2013 that it's imperative that the company undertakes a big modernization effort and replaces a large portion of its partially obsolete plant and equipment by new modern technology plant and equipment. And this replacement is costly. It replaces, let's assume it replaces much higher cost productive asset with lower cost productive assets that are obsolete. And that means that your denominator will be high because you put many more new modern assets. But those assets, hopefully, are going to increase your profits, your returns in future years. But it will take time until they will bear fruit. So as a result, in 2013, you increase your assets substantially, but it doesn't show yet much in increased profits. So with assets increasing substantially, profits not that much, what happens to the ratio? The ROI shrinks. But this is a deliberate policy to assure higher profits in the future, to assure higher returns on investment in the future. Now, how do you take account of that? How do you explain when you analyze the ROI that many of the investments here are future oriented? So that's an important timing issue when you analyze the meaning of the ROIs. Because mostly ROIs are limited, each ROI is a one-period investment measure, return on investment measure. It's not a multi-period measure, but the effects could be multi-period effects. That's important to remember. So the return on investment is a ratio measure. It's a ratio of profits to assets. We have two other prevalent measures that instead of being ratio measures are difference measures. They represent a difference between the profits and a charge against profits in terms of minimally required return on investment. Those measures are known as the residual income, RI, and the economic value added, EVA. So let's define those measures. The RI, residual income, is the difference between earnings and investment charge toward earnings, where the investment charge is defined as the minimum desired ROI times assets. So you ask yourself, what is the minimum required or minimum desired return on investment? So you come up with 12%, and you multiply it by the level of your assets to ask yourself, if my minimum required rate of return is 12%, how much do I have to generate to satisfy this minimum requirement? So it will be the 12%, the minimum required ROI, times the value of the asset base, and you compare this number to the actual earnings, and the difference between the two is whatever residual income remains after you satisfy the minimally required income. So that difference is called residual income. Now, a related measure is the economic value added, which is also a difference. It's a difference between a measure of profits or earnings, which they call NOPAT, which stands, as you can see down here, NOPAT stands for net operating income after taxes. And you subtract from the net operating income after taxes, NOPAT, you subtract a charge and minimally required return, which in the economic value added format, instead of minimally required rate of return, they usually use WACC, which is the weighted average cost of capital, WACC, weighted average cost of capital, which is the same animal that you know from corporate finance, weighted average cost of capital being the weighted cost of debt and equity. And you multiply the weighted average cost of capital by the investment base, but in economic value added, the investment base is measured as the market value of the assets of the investment capital, market value, and it includes capitalized items. So if you take this difference, you get a measure that is known as the economic value added. Now, there are the features of the residual income and the economic value added. The important features are as follows. Both the residual income and the economic value added focus on the dollar value rather than on return ratios. So they're not ratio measures, they're dollar value measures, which are difference between earnings and charge to capital, minimum required earnings and capital. Both residual income EVA can incorporate adjustments to risk. That's important. The ROI doesn't directly incorporate adjustments to risk, but in residual income and economic value added, you can, in the minimum desired rate of return on investment, or in the weighted average cost of capital, you can include the risk premium by upping the number if you think that the operation is riskier or the company is riskier. You can up the number to include a risk premium. So this way you can adjust it for risk. Now, if you want to compare investments over time, or investment units, or performance of company over time or cross-sectionally, you have to adjust the RI and the EVA because they're not adjusted for scale. There could be higher just or lower dollar figures just because you have a lower, higher scale of operations. The ROI adjusts for scale by dividing the profits by the value of the assets. So larger units have more assets and smaller units have smaller assets, and that's the adjustment. Well, you could do the same for the residual income. You can adjust the residual income or the EVA for size by dividing them by the value of the assets, and then you get a residual income ROI or EVA, economic value added ROI, which are residual income or economic value added measures adjusted for scale or size. Yes? Sure.
That says RI equal earnings minus the last word.
Yeah, let's repeat that. It's MIN minimum, min, desired ROI. That's a minimum desired return on investment, or a minimum required return on investment, which is how much do you require to clear a minimum level of investment. I'm sorry?
Times asset.
Times assets, right. We'll go through a numerical example.
I guess that's a type. MIN instead of
No, MIN goes for min desired ROI. That's a bit difficult to read, but it's min desired or min required ROI, and you multiply it by the value of the assets. So what you get is, what is the minimum income that you require, right? If you say the minimum desired ROI is 12%, if you multiply 12% by the value of the assets, you will get the minimum required or minimum desired earnings, and you compare it to the actual earnings. You take the difference between the two. You're very welcome. Any other questions? Important to clarify. And we will go over numerical examples that hopefully will clarify it further. So the residual income requires investments to clear minimum hurdles, minimum desired or minimum required return on investment. That's the residual income. The economic value added requires investment to beat alternatives, where the alternative is usually represented by the weighted average cost of capital. Remember, in the weighted average cost of capital, the cost of equity represents the best alternative return to your equity part. Now, EVA usually requires that the asset measures, that the measure for the value of the assets will be market values. And the EVA relies less on GAAP because the adjustments that it makes for the calculation of the net operating NOPAT, net operating profits after taxes, includes many cash flow items. So that's getting away from accruals. So that's another difference. We're going to go now, if there are no further questions, we're going to go through a number of numerical examples now, which will make things hopefully clearer. So for that, we would like to go to the slides. Let's go to the slide. Actually, let's go one slide before. And slideshow. Okay, let's go through the ROI example, numerical example first. So we have a company that is called CompuCity, and that company sells three types of products classified as computers, software, and books, and it sells them in three locations: Boston, South Florida, and the Midwest. So let's look at the numbers by products. So in this exhibit, panel 1 gives you the raw data. It gives you income or profit data for the 3 type of products in total for 2009 and 2010. It gives you the investment, the asset base, and it gives you dollar sales for the products for the years and the total. And then in the bottom panel, you have the returns on sales, the asset turnover, and the ROI calculated based on the top numbers for the 3 type of products each year and then for the total. So if you want to go through the numbers, let's look at computers 2009. The return on sales is 4%. How do we get to 4%? 4% is 8,000 income divided by $200,000 sales. Tells you that the return on sales in terms of income is 4% of sales. The asset turnover for 2009 for computers is 4, which is the ratio of sales, 200,000, divided by the investment base, which is 50,000. That gives you 4. And that is called the asset turnover. How many times presumably the asset has to turn over to produce sales of 200,000. So it's 200,000 divided by 50,000 is 4. Now remember, we said that the ROI can be calculated as the product of the returns on sale times the asset turnover. So returns on sale, 2009 computers 4%, asset turnover, 2009 computers 4. 4 times 4% gives you return on investment of 16%. Now you can calculate the 16% directly by invoking the return on investment, direct return on investment formula, which is income, 8,000 for 2009 computers, divided by investment base of 50,000. 8,000 divided by 50,000 gives you 0.16 or 16%. And you can follow for every product and the total. So any question about those numbers? Okay, now you could analyze those numbers. For example, you could look at the total average return for the company, and you could see that there's been a decline from 2009 to 2010 from 14.4% ROI total to 13.5%. And you may want to ask yourself, why this decline? Is there anything that happens that I should worry about? And you may look here and see that in terms of the total, much of the decline presumably emanates from a sizable decline in returns on sale from 6.1% to 5.1% over this period of time. And if you look further, for example, you could see that among the products, that's the total, But among the products, the biggest decline on the returns on sale was where? In computers. The returns on sale went down from 4% to 2%. It's about half. So these numbers lead you to, they're sort of signals. They lead you in terms of if you want to investigate them, if you feel that they're worrisome in this case, they lead you to investigation, to ask yourself, why was this decrease in return? Well, why then was this decrease in return on total sales? And one of the main factors here was the decline in return of sales in computer was significant. What are the causes behind that? So that's where these numbers are helpful. Now remember, these numbers, like variance numbers, they're only signals. They're flags. They don't tell you, they tell you by no means what is the reason. They tell you just where there may be a potential problem and where you should look further in terms of deeper analysis. But they don't tell you what the causes are. You should be careful in jumping to conclusions before further analysis. What does jumping to conclusions mean? You can jump to conclusions and say, oh, the culprit obviously here is something to do with the return on sales performance of computers. It went down from 4% to 2% return on sales. Looks like something went wrong with the performance, with the effectiveness of marketing that got us a decline from 4% return on sales to 2%. Well, maybe right, maybe not. There may be many other factors. Can jump to that conclusion before you do a much deeper investigation. Now the bad news is that work has to be done. You just cannot infer things by cursory look at the numbers. The good news is that that's why managers, cost managers, and management accountants are needed, right? If we could infer everything just by looking at the numbers, right? So our analytical talents and managerial talents will not be necessary. But that's where our analytical strengths should come to bear. So actually, from that point of view, it's good news. But generally it means, remember, all those numbers are like gauges. They tell you that something, there may be some problem and something may be awry, but they don't necessarily tell you what. It's like you're driving your car and you look at the gauges and suddenly the gauge that shows the temperature of the engine, all of you have that gauges, all of us have these gauges in our cars, suddenly it goes far beyond the normal range. So all we know that there's a good chance that our engine is overheated. Not 100% the case, because it may be that the gauge has gone haywire, right? That nothing is happening with the engine, but something happened with the gauge. But it may, but the greater likelihood is that the engine is overheated. But we don't know why, just by looking at the gauge, right? So if we are on the highway Prudent thing to do is to slowly move to the right lane and gradually stop and get off to the shoulder or to an exit if there is a closed exit. Park the car safely and try to find out what's going on. Approach the hood carefully so that if there is an overheating, you're not going to be burned. Wait for it to cool, then open the hood. For those of you mechanically inclined, maybe you will get an inkling by looking under the hood as to what is wrong. A person like me looks under the hood. I don't understand much, so I probably won't know. So maybe you will, and maybe you will need to get the car to the mechanic in the garage to diagnose. That's where the in-depth analysis goes. So remember, all those variances, all those indicators of performance, such as an ROI, are only signals, flags, gauges that show you to a certain extent where you may want to begin to look further for leads. Okay, another interesting chart here in terms of the numbers just illustrates something that we discussed before, and that's the sensitivity of the ROI to different methods of measurement of earnings, profits, or assets. In this case, the focus is on different methods to measure assets. And basically, here you get figures for the different areas the company operates in. CompuCity operates in the Midwest, Boston area, and South Florida, and gives you the income. And then it focuses on different measurements, possible measurements of the asset base, the denominator, and it focuses on 4 different measurements. One measuring the assets by net book value. NBV stands for net book value. Gross book value. Replacement cost, that's the cost of replacing the assets now, if you want to replace them. And liquidation value, what can you generate in dollar terms if you decide to liquidate the assets, sell them, and liquidate them. It's missing, for example, the market value, but doesn't matter. The example is good enough as it is. So basically, you could see that the numbers are quite different. And not surprisingly, the gross book value is significantly higher than the net book value, because the gross book value gives you the acquisition costs, historical cost, acquisition cost of the assets without depreciating them, gross of depreciation. The net book value subtracts from the acquisition cost of the assets the accumulated accounting depreciation. So obviously the figures are going to be significantly lower. The replacement cost figures are higher because it's usually costs higher to replace, there's inflation and there's other increases in the prices of the assets because of innovations and so on. So the replacement is costlier than the historical acquisition costs, the replacement value, and liquidation value is usually also higher. So you can see the numbers are significantly different, which means that the returns on investment, depending on which measure of assets you use, is going to be also significantly different. Because the net book value numbers are significantly lower, if you measure return on investment based on net book value of the assets, you're going to get higher ROI numbers because you're dividing by a lower denominator. And the lowest numbers you're going to get on replacement cost and liquidation value because you are dividing the same income by a higher asset base. So you could see how the different use of the assets can produce different measurements. And the measurements have to be interpreted differently. Now, if you look at numbers, several interesting things pop up. For example, there's a big increase here, very unusual, in the liquidation value of the assets in the Boston area. They're very high compared to NBV, gross book value, and even replacement costs. They almost double the replacement cost, and they're almost 3 times as high as the gross book value. And they're also high compared to, so historically, over time, well, they're high compared to different, no, we don't have it over time here. They're high compared to different measurement bases for the Boston area itself, and they're high compared to other geographical areas. So we may want to wonder what's going on there. These big, assuming that the measurement is correct, why this big measurement? Now, we don't know just by looking at it, but there may be a lead of where to look. If we wanted to guess, what is a reasonable likelihood why the liquidation value for the Boston area is so high? A guess. We don't know what's our. We can just guess before we take a check. Right. Liquidation value is what you can get if you liquidate the assets. Sell them. Sure. So the question is, what could it be? Well, anybody wants to venture a guess? Yes. Transportation, but this company is not dealing with transportation, right? So why would its assets be affected by transportation? In terms of? What do you think could happen in transportation in Boston? Well, they're not. They're involved in computers. That's the same company. They're involved in books, computers, and software. Any other guesses? Yes. Like what? Why would there be more financial instruments there? No, but they're dealing with certain products. But you come close. You're coming close. There's something maybe peculiar in the Boston area. Well, what peculiar things to what happened in the Boston area that may not happen in other areas? Remember, assets can involve buildings and land on which the building stays, so can involve real estate, right? It's just a guess. We don't know. Maybe the real estate in the Boston area just went up sharply. And if you want to liquidate, if you sell, because the appreciation here, not depreciation, if you measure it by liquidation, you measure by how much you can sell. How much you can sell reflects the appreciation of real estate. Maybe the appreciation of real estate was such that if you wanted to sell your assets in the Boston area, which include real estate, the real estate assets could sell for a very high price. Just because, you may have been lucky, and maybe real estate in Boston went up fast, and maybe, I don't know, your buildings and land are just near a completed convention center, and they're highly priced. Yes?
The same price still high in the replacement.
Yes, but why is it not that high? It is higher, but why it's not that high? Because maybe, remember, replacement cost is how do you replace? Maybe, just maybe, if you replace your real estate assets in the Boston area, but still remain in the Boston area, but you move from central Boston, where they are, to the periphery, it's still high, but it may be lower. So you can replace by moving to another location. Remember, real estate is location, location, location. So if you move to another location, you may be able to replace the very high-priced real estate by still expensive real estate, but at a lower price. But if you sell, you get the higher price because that's where you. That's just maybe one reason. We don't know. But let's assume that's the case. Well, then some interesting things come to mind. Should we move? Should we sell at a very high level at the central Boston, for example, and move to the periphery? May save us some cost, and we can get some extra cash. Or maybe we should, if the real estate cost didn't go up much in Florida and the Midwest, maybe we should liquidate our operations in Boston and move them to the Midwest, South Florida, or another area. I'm not saying that that's necessarily the case, but you see, because of the high liquidation value, the return on investment for the Boston area based on liquidation area is now, a liquidation value is now 3.1%. That's low. So maybe we can either move out of the whole area or move to another area within the Boston area. But these are things that we may want to consider, and the numbers may give us a lead, or at least these are things that we may want to examine. So it's just example of useful leads, indicators and leads that can be provided by such numbers. Yes?
So can we see the liquidation value of the market value, let's say?
As a what will liquidation value as?
Market value?
Not necessarily, because it can be close, but
What's the difference in the liquidation value and the market
Well, liquidation value is the value that you get if you sell the assets. Market value is their value at the market, and you're right, they're close. So the question is, and the differences may at times be slight, but for certain types of assets, they may be significant. For example, if you talk intangibles. For tangible assets, they're close. If you talk intangibles, for example, if you possess certain reservoir of skills or technology, selling it, for example, may give you less than its market value because other companies are not yet ready to use it the way you can use it. So essentially, for you, the value can be higher than the value if you sell it, right? Could be, in that case, liquidation value lower than market value, but as a whole, your point is well taken in the sense that in most cases, for tangible assets particular, the liquidation value and the market value should be quite close. Sure. Well, what are the sunk costs? If you sell, liquidation value is you sell your assets. Are there any sunk costs? You're saying sunk costs, but what are they? Oh, selling costs, not sunk costs. Selling costs. Yes, you subtract, obviously, if you sell your buildings and land, you subtract the transaction cost, the cost to the brokers, and so on. It's the net, liquidation cost is the net cost that you get. Sure. Sure. It's a good point. Yeah, of course. Okay, any other questions here about this? Okay. Advantages and disadvantages. The advantages of ROI are self-explanatory. They're widely used and they are easily understood. It's not a kind of measure. It's not quantum physics. The rationale and the meaning of the measure conceptually is well understood. And you can compare the rates of return to minimally required interest rates, and if the rates of return that you get, the ROIs are higher than what is minimally required, then you're in good shape. That means that you're performing reasonably well because you're doing better than what is minimally required. One important disadvantage is the following. It may not be goal congruent because the incentive for high ROI units to invest in projects with ROI higher than the minimum rate of return but lower than the unit's current ROI. Now this is stated in a convoluted way, so let me elaborate on that to make it clear. Let's assume that you are an investment unit which has several projects, investment projects, and your average ROI for all the investment projects, which is the ROI for your investment unit, is 16% or 0.16. Let's 20 in terms of percentage, 16%. Now, let's assume that the minimum required return on investment is 12%. Now let's assume that your investment unit with the average return on ROI of 16%, let's assume that this investment unit is considering an additional project, whether to undertake or not undertake an additional project, and the ROI for the additional project is 14%. So now, from the point of view of the company, it's good for this unit to undertake this project because 14, not 19, 14. It's good for it to undertake the project because the project will give it 14% and to the company 14%, while the minimum required is 12%, so it will still add to the profits beyond what is minimally required. However, let's assume that this unit, whose average return on investment is 16%, its performance is evaluated solely on the basis of the return on investment. Well, if you're a manager of the unit and you're running an average return of 16%, and now you're considering adding a project that you estimate will return you 14%, what will happen to your average return? Think about this. If you're running in this program an average of A, and you take another course and you get in this course, God forbid, B+, which is still a very good grade. But what does it do to your average? It decreases your average, right? So obviously here, if the additional project gives you 14%, while your average is 16%, it will decrease your average. If the managers of this investment center or investment strategic business units know that they are evaluated solely by their overall average or ROI performance, they don't want their average to fall, so they may be inclined to reject this project, even though this project is good for the company. So that's one of the weaknesses of the ROI. Of course, what that points is to another problem, which is usually a good rule for top management. Never judge the performance of your centers by one measure only. Because if it's easy to judge by one measure only, right? But if you judge by one measure only, you're likely, in a good number of cases, to get counterproductive behavior on the basis of non-goal congruent behavior, that is, get behavior for your centers that may be good for them, may serve their interest, but may not serve the interest of the company as a whole. So that's one of the disadvantages. Of course, that's not the only disadvantage, but there are many other disadvantages that are disadvantages of all of these measures, so we'll talk about them later. Yeah, comparability across investment centers may be problematic, but that's true of other measurements as well. Okay, let us go through an example of how we calculate residual income. And the example here is drawn for the same data that we discussed before, and for the Midwest region, where the investment, and the example is based on a net book value measurement of investment. The net book value measurement of investment for the Midwest was $192,500 asset base, and the minimum required rate of return was 12%. So the minimum that the Midwest requires is 12%. So what is the minimum income then that they require to generate? It's 12% of their asset base, of their investment. So it's 12% of 192,500. So if you calculate 12% of that, you get that the minimum income is 23,100. The actual income, if you go back to the figures, to the raw figures, is 26,000. So the actual income being 26,000, you compare 26 to 23,100. So your actual is 26. The minimum required is 23,100. So the residual income, which is the residual beyond what is required, is the difference, or 2,900, and that's your residual income. So that's simple. You can do this calculation for each of the regional centers. You can do a calculation for each of the product lines. Any questions on how the residual income is calculated, or what does it mean? So obviously, by the residual income standard, you're going to accept, or the guidelines are going to be to accept projects with a positive residual income. So as long as the residual income is positive for any project, you will accept it because it adds a residual income beyond what is minimally required, which is positive. Of course, if the residual income for any particular project is going to be negative, you're going to reject it. Or if the residual income is negative for the whole region, you're going to start asking questions, because then the region is not contributing beyond what is minimally required, not contributing to profits beyond what is minimally required. So now if we look at all the regions based on net book value for the investments, the incomes are given, so that's the way the ROIs were calculated. And now the RIs are calculated, well, we calculated for the Midwest. Same method is used to calculate it for the Boston area and the South Florida area. You see that the RIs are positive. The residual incomes are positive for all areas. And that's because the ROIs for all areas exceed the minimum rate of return required, which is 12%. Okay, any questions about residual income? Okay, the advantages of residual income and the economic value added, it supports incentives to accept projects where the ROI is higher than the minimum rate of return. We saw that. It can use the minimum rate of return to adjust for differences in risk for different projects or different areas of different product lines. And we know that because once we have a minimum rate of return used, we can adjust it for risk by adding a risk premium to areas or projects that we consider more risky. We can use different minimum rates of return for different types of assets. Now, residual income is not adjusted for scale in its original measure, so it's influenced by the size of the project. So because it's a difference measure of a dollar value of a contribution to profits above a certain minimum, it can be affected, can be larger number just because the units are high, the unit's size is bigger. So you can't just compare different units by looking at the residual income. You have to adjust the residual income for scale by dividing it by the asset base. Not as intuitive and maybe as the ROI, and may be difficult, it may be difficult to decide what is the minimum rate of return when you talk about subunits, such as investment centers within a company, rather than when you talk about a company as a whole. Okay, we discussed this. Now the economic value added, there are some common adjustments. Now, there are many more adjustments to typically economic value added measurements than the ones mentioned here. Some of them are mentioned here. The adjustment to the capital and adjustment to the net operating profit after taxes. Since there's so many adjustments that are made, I'm not going to hold you responsible to any of those adjustments. And the reasoning is simple. If you ever come to a situation where you're in a company that uses economic value added, there will be procedures there as to what type of adjustments they make, and you will be able to familiarize yourself with it. So just remembering now all types of possible adjustments is not going to do you much good, except knowing what economic value added is in general, and the fact that there are many adjustments that can be made to the profit measure and to the capital, to the asset base. Okay.